Testing 1, 2. Can anybody hear me? I see people there. All right, well, that's not good if nobody can hear me. All right, participants, find privileges. Oh, thank you, guys. Thanks, Eric and Francisco. Attendees. All right, let's give you guys privileges to reply to all. All right, so when you reply, please speak to all participants so that it doesn't seem like I'm talking to myself. And we're going to get going momentarily. And let's see, first we'll do our lovely disclosure. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trade. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Oh, that's not good. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides educational and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money you can't afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, now we can get going. We will then share the screen. Let's see. Share my screen. This works. Now it looks like it's working. Chat, you can see a very unexciting screen at the moment. Let's see, can you now see my Thinkorswim or swim screen? Hopefully you can. Anybody? Feel free to participate. Okay, come on, one guy. Tell me you can see the screen. Okay. Yes, thank you. Geez, it's not so hard as it can. All right, thank you, Ken, for getting the seminar rolling along, and now we can move forward. All right, as you can see, this happens to be my active futures trading screen, and we have the Nikkei down here. Been watching that closely because we liked shorting it when it was higher. Unfortunately, it didn't quite get high enough to fill my order this morning, so I'm out of it at the moment. But we had a good day yesterday trading it. The Russell's been very good to us. We but short. My average short on the Russell is 1263.10, and we're up $1,900 so far for the day. So that's pretty good. That was off this big move down here that we made some good money. So now it's back up here, and we're shorting it again. You know, it's no big deal. Oil, unfortunately, is taking half my gains. It's down we're down $830 on this trade, and my average entry on oil is 53.30 or 53.29. Just got, you know, at a certain point, you know, even if you're scaling in, you got to give it a rest and see where it's going to end up. And so even though it went all the way up here, I don't just keep buying. At 54, I probably would have started giving it another crack at it, but I didn't want to just start adding just because it went up to 53.75 basically. It wasn't really high enough to make a big difference. It was like, you know, because who knows? Sometimes these spikes go $1, $2 and get completely screwed on it. So it's better to wait and see before I overcommit to a position. But fortunately, the Russell is paying for it, so we're okay. And over here is the S&P. Now, if you look at the other charts, the S&P, basically, the NASDAQ is down 0.5 point. The Russell is flat. What's different about the Dow and the S&P? Well, they got a lot of energy stocks in them, right? You got Exxon, and you have Chevron, and you have, and the S&P's got a big energy sector. Those guys are all doing very well today as the oil has popped up, and oil has gone crazy. Hang on, I just got back from my vacation, so these aren't set up right. Why did I lose my chat box? And I can't, oh, there you go. All right, so as you can see, Brent hasn't moved that much. Brent's only at 1.8%. And so it's really a local phenomenon, and it's being caused by the NYMEX contract rollovers. So now we're back to 53.37. Now, see, here we go saying, now we're back to my average, I think. So what I should do here is scale out a little bit, because I didn't want to be in 5 positions. See, we're down to 386 close. I didn't really want to be long, short 5. I wanted to be short 2. But what happened is it popped over where I entered, and I hit another one, and my average is here now. So what I'd ideally like to do is be back to 2 or 3 at this price. So hopefully we get a little bit more of a pullback back to like 52.90, and I can get out of a couple of these and be happy. I mean, especially as I already have like a $2,000 gain on the Russell, so all this is just gravy. So it's, you know, I don't care if I only make a little bit of money on oil today. All right, so what else is going on? What were we talking about this morning? Let me see if I can figure this out. Got that. Is this today's post? Yes, it is. No, it isn't. This is last week's. We just did some news, so we can go talk about that too. There's some interesting things going on. So today we were watching for the big chart levels to break down, and we tested. We had a nice little sell-off, but we haven't actually broken anything. Everything's held up so far. Where's the NYSE? That's the most important one. The NYSE is right at 11,100. It's up 50 points because of the energy stock. So it's reversed that fall, and now it's up here. So all these energy stocks are flying because of oil. But oil is up strongly, mostly because the dollar is down so much. Look at this dollar drop. So from 100 to 98.50 is 1.5%. All right, and that's helped oil punch up. And also they like to run oil up because it's contract rollover time. It's not like tomorrow there's going to be some kind of massive draw in oil. That's not happening. We're going to have the same probable build in inventory that we've been having for ages. So, you know, maybe not as big, and anything less than the big one will be a relief at this point, but not enough to knock you up from 50 to 55, from 5, you know, it's a 10% gain. And adding to that, this morning, we were talking in chat about the amount of contract rollovers that have to occur. And let's see, where did I put that thing? There. All right. So I hope you can see my pop-up calendar. So the NYMEX contracts expire on the 3rd business day before the 25th. All right. So you have 1, 2, 3. So Wednesday the 22nd is, no, I'm sorry, no, 1, 2, 3. Yeah, so Wednesday the 22nd, I believe, is the expiration day. That means they really have, from today, they've got today, 4, 5, and 6. They have 6 business days with these contracts before they expire on the 22nd. When they expire, they're stuck with all these oil contracts. These guys don't really want 200,000 barrels. This is 200 million. These are 1,000 barrels per contract. They don't want 200 million barrels of oil delivered during May. That would be more. That would completely. I mean, we don't have space in inventory for that. There's just no possible way they want these delivered. They're fake orders. They're just trying to boost up the apparent price of oil in the NYMEX contracts. And that's where we were this morning, by the way, 51.91, and now we're at 53.45. So that's a pretty big pop for the morning. They've already got all these orders, and every month they're fake orders. They're never ever going to take delivery of these barrels. They're just rolling the orders over to make it appear that there's a demand for oil on the NYMEX. And so they keep the prices above 20 in the first place. Sometimes they get it right, and sometimes they don't. So they got to roll these contracts over. That means they have to cancel these contracts and put them into these contracts. Right now, The spread is nasty. If they have to cancel this contract at $51.91 and roll it here for $53.74, they're paying $1.74 a barrel just to push back a month. That's a very, very high spread. So what they're doing now is they're trying to work that spread off, and they work that spread off by jamming the May contracts as high as they can without hopefully affecting the June contracts by too much. And so far they've done that, and now you've got these contracts are, these guys are up to 50, they're about $1.50 spread now. They're working on it. They worked it down from $1.80 to $1.50. And that's how it's going so far. They just want to cheapen the price of the roll of those barrels. That's all they care about. But there's no reason for either of these oil contracts to be going up right now. Chrissy says, your USO play, I don't know how you got $4. What? I guess she's reprinting a comment from chat. Hang on, I'm going to read this. July 5s are at 3:30 with UCO at, it's not a USO play, it's a UCO play, with UCO at 8.10, so 20-cent premium. Okay. If you sell the 9s for $1, your max becomes 4 plus $1 you collected. July 5 is 3:30. UCO being a 2X ETF, your max becomes 4. That can't be a whole sentence. I mean, it has to be part of a comment. Well, I assume that we're talking about buying UCO. I don't know. Hang on, let me see. UCO. See, it needs to be more in context than that, so it's kind of hard for me to say. But UCO is $8.50. If you sell the July 5s, oh, okay. If you sell the July 5s for $3.40, well, that, and you bought it for $8. Well, if it was $8.10, let me get down. I need to calculate it. Hang on. Let me make sure I get this right. Oh, dear. All right. So, if we bought at UCO at $8.10 at the time, minus $3.30, if you sell the July calls, that's $4.80. And then if you sell the 9s, I wonder what 9s I was talking about. Was I talking about the $9 puts? Maybe I was talking about the $9 puts. I really don't. I imagine I was talking about selling the $9 puts for another $1, and then you knock $1 off $4.80, and your net entry is $4. But I'm not quite sure what that meant exactly. So I don't know. That's my answer to that one, Christy. I'm sorry, but I'm not sure where we were with that or where we were talking about $4. I have to look at the whole thing in context again. We are obviously talking about a complicated trade based on. Let's see. Are you printing it again? No. I mean, we're obviously talking about some part of a complicated trade. I don't know exactly what it is. Now, actually, you can catch the 5s, blah, 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 blah. Wow, that was a lot of words. It was my play. I don't know. 5-9. Oh, well, if we had a 5-9 bull call spread, that's different, though. Because if we had a 5-9 bull call spread, you're buying these for you're buying these for $3.70. You're selling the 9s for $1. I mean, using today's prices. So let's say it's $3.50 minus $1 is $2.50. Then if you sell the $5 puts, it couldn't have been these $5 puts. So was it like 2017 $5 puts? That would make more sense. Those are $1. And if you sell the 17 puts, so I'm sorry, what was the net? Now I lost track. If you buy these for $3.50 and you sell these for $1, okay, that's $2.50. And if you then sell the $5 puts for $1, then you're down to $1.50, and it's $1.50 on the spread. And your worst case scenario there is you'd end up owning them for $6.50 because you did spend $1.50. So I'm still not sure where that came from. All right, so yes, I will have to tell you later. I have to look over this and figure out what the hell that was the context of. But anyway, so UCO is a ultra long oil play, and we have these in the short-term portfolio, I think. Let me take a look. Wait, were we done talking about this? Yeah, so anyway, so the contract rollover, it comes this time of the month. And we certainly expect at some point there'll be a plunge when the people who are stuck with these May contracts have to dump them out. 90% of these contracts will be canceled by next Wednesday. 90%, probably more than 90% of these contracts will be canceled by next Wednesday. They've got to get rid of these contracts. They can either roll them now. In the NYMEX, you're allowed to roll even if you don't have a buyer. It's a messed up process. How does oil ever move up? Well, it's constantly being manipulated. That's how. There's no actual. It only moves up on speculation. It's not. They always had too many contracts, but sometimes they manage. The reason they always had too many contracts is because they force these contracts in. But yeah, they have gotten to a point where it's damaging. But oil jumps up on news. There's no fundamental basis for oil. These contracts are complete fantasy. It's like saying, how come the fantasy league trading doesn't affect the World Series? It has nothing to do with the reality of oil. It has nothing at all. There's this little tiny trading on West Texas Intermediate crude, which is 5 million barrels out of 5 million barrels a day out of 80 million, 90 million barrels a day globally. So 5% of the world's oil is represented by this number. It's trading a very specific contract that and Brent crude also. But those are the contracts they like to trade because they can manipulate those. If they traded global oil, oil would be $30 a barrel. But instead, they pretend that these tiny little markets are going to represent the entire planet's pricing of oil, which is asinine. All right, but they want it that way. That's why the system's rigged that way. It's rigged to screw you over. It in no way reflects the actual pricing of oil. All right, and the same thing with metals, and the same thing with everything else. The traders are setting a price, but they're setting a price in an artificial, contained market that has no bearing on the reality of buying and selling oil across the country, across the planet. And nobody changes it. Nobody does anything about it. It's just the way it is. All right, so you just have to accept it and play it. I mean, God bless them because we make a fortune trading it this way. But it is a complete and utter scam. So don't try to apply logic to it. There's no logic to it other than understanding it's a rigged game. And they're going to artificially manipulate it up and artificially manipulate it down. But then the reality is what you say is, well, okay, it's a rigged game, but they can only affect it so much before it, they can only affect it so much before it becomes so obvious that it's wrong that it goes the other way. That people start saying, well, you're so far off base here, the supply and demand is so far out of line where you're trying to move oil to, that this can't possibly hold up, which is exactly where we are right now with oil. Okay, right now, at whatever the hell price it is right this minute, it's way too high. And this is the best time of the month. And it's always the time of the month that we make our money on oil. This is always when we start shorting oil. And we're doing it again because this is normal. Every month it pushes up towards the last 10 days of the contract. And every month at some time during the last 10 days of the contract, you have a huge sell-off. And everyone is surprised every time. It's the most amazing thing in the world. Everybody's like, oh, wow. Look at that, oil went down all of a sudden. And so within 3 days from now, or three to 5 days, I'd say, oil is going to suddenly go down about $2, and everybody's going to go, wow, who would have seen that coming? All right, but you can either bet on it or you don't bet on it, but that's the way it works. Pat says, any option plays on oil, we can take advantage of oil being so high. That's where we were going with SCO. So first I was going to look and see what we have. We're making a fortune. And again, because we know this is how it works, it's very easy to anticipate. So this is what we do. So in our, look at our long-term portfolio. Holy cow. I wish we had some stocks in there. we have let's see, wait, the total balance of this portfolio is $733,000. We have $752,000 in cash. We have minus $18,000. The value of our positions is negative $18,000. That's pretty humorous. We have more cash than the portfolio is worth. It cost us $18,000 to close out these positions, but that's because we kept these positions when they were down about $45,000, and we cashed out all of our winners. So we took all our winners off the table, went to cash. We left our losers on, which were primarily commodity plays, especially oil, and now the oil plays are doing fantastic. So we're making a fortune. We are making ridiculous amounts of money. This thing's up 46%. I mean, it's just crazy. And what do we have here? We have these long USO calls, which, by the way, is still losing money. So you want to talk about an option on oil. These are the 2017 $18 USO calls, and they're still $3.35. We bought them at $4.20. We haven't changed our mind about them, but we bought them at $4.20, and they're $3.35 now. So that's a 20% discount for you. Yeah, nice 20% discount if you want to get in that trade right now. We sold, this one's doing okay already. We sold 25 of the USO January $15 puts, because again, this is ridiculous. The January $15 puts, that's 20% below the current price. So 20%, because the current USO is currently at 19. So 20% below the current price is $15. That would be, what's oil now? 50 something? That's 50. So that's like $40 oil. So what's this bet saying? In 2017, I think oil is going to be higher than $40. That's my bet. And you know what? If it isn't higher than $40, I'm willing to go long on oil. That's all I'm doing. I'm willing to take the USO ETF, and I'm willing to go long on oil at $40 in January 2017. That's my worst case scenario. Is I'm long 2,500 shares of USO. All right, so that's my worst case. Meanwhile, for me to make that promise, which is ridiculous, which is something I absolutely would want to do, in this size portfolio, keep in mind, this is now a $700,000 portfolio. It's not a big commitment. It's only a tiny commitment to say I want to take 2,500 shares of USO at $20. It's $50,000. This isn't a major piece of the portfolio. It's not nothing, but it's not, I'm not killing myself. Meanwhile, I'm getting paid $5,000 just to promise to buy it. That's what it is when you sell the puts. So I'm selling these puts. I get paid $5,000 to buy the USO. I'm sorry, to promise to buy USO for $15. Even though it's 19 now, they're going to pay me $5,000 to promise to buy it for 15. This is how crazy options are. There are people who are they are willing to pay this, so worried that the oil that they do owe is going to go to zero or whatever, that they're willing to pay you $5,000, which is 20% of how much money I would have to buy the oil for. So my net cost wouldn't be $50,000. My net, that was 10%. My net cost wouldn't be $50,000. My net cost is $50,000 less the $5,000 I have in my pocket. $45,000 now I only have to spend. And you know what I would do if I got assigned? I would take the assignment. I'm out $45,000, and I would sell $5,000 worth of calls. And now I'm down to $40,000. And that's how quickly you can move these things. Yeah, I'll look at the STP next, Pat. Thanks. All right. We have Transocean, Rig. I love these guys. They're almost back to where we bought them for, this combination. We have Seadrill. They're up a little bit. We have, these are all in the long-term portfolio, which is under our portfolio tab. You can see all these positions. Look at our Canadian bank play is already making a little bit of money for us. That's a new one. We have DHI. We love that one, but that's already kind of off to the races. CLF is a whole different, ball of wax. Lumber Liquidators not working anymore, but we'll see how it works out. I'm sorry, it's not working. It's just that we, what do? We sold the 55 calls. So those are crazy. This is what's silly about the Lumber Liquidators. The short 55 calls are being valued at $450. So that's crazy. We sold the 40 puts though, and we bought the 30 calls. So we have a very wide spread here. It's not really that it's losing money, so I still like this trade. It's just that they have incredibly huge premiums that make it look like we're losing money. Here's Lulu. They ran away from us. We have to fix that position. Mattel, so. Okay, OIH is another oil play, but that's still doable. That's not a bad play. Here's Transocean again. And that's when we had lost a lot of money on, so we just had to pray that they actually one day get back to $27. You know, we got 2 years, I'm not too worried, but $27 is our target for Transocean. And then we have UCO. And now UCO is the ultra long on oil. We were very aggressive here, and we bought the $5 calls. We sold the $10 calls, so that's a 5-10 bull call spread in 2017, and we sold the $6 puts because, again, it's that same 20% logic I was talking about with USO. I said, I don't care. So what am I agreeing to do? I'm agreeing to, and I only went out to July, by the way. We didn't go out to, this isn't a 2017 thing because you don't want to really do an ultra. They tend to decay over time, but in July. So again, it's only going to kick in if USO is like if oil is like at $40. Other than that, I want to be long on oil at $40. You know, so it's like this isn't really a difficult decision to get into a trade like this. And again, 50 is going to be 5,000 units if we end up having it signed at $6 is going to be $30,000. Don't mind, not at all. All right, you know, we don't feel bad about being long on the commodities at this point. And again, we have $750,000 in cash to deploy. So if I end up getting long on oil here, long on oil here, whatever, and we have to wait 2 more years for these things to roll around and for oil to come back, fine. It's not a big deal. It's very hard to imagine that oil can stay that low for that long. Chrissy says, can you explain the CM straddle or strangle? It's not a straddle or a strangle. It's what we call a buy right. I mean, basically, we buy the stock, 300 shares. We sell the calls. Okay, so it's just a covered call, just like anything you'd always do. And while we're at it, we're also promising that if it goes to $75, it's at 75 now, but if it's still at 75 in September, we're willing to buy 300 more shares. All right, so for that promise, we got paid $450 here, and we got paid $325 here. So that knocks $775 off our $74.50 price, which is, you know, like 15% or about 15%. So we basically saved ourselves 15% between now and September. Now, when we bought the stock was at $74.50, so right about 75. So we're agreeing to sell the stock. We're saying we'll sell the stock for 75. We bought it for $74.50. So it's really the discount is where we make all our money. It's this sale of these puts and calls that's going to be our profit. But if let me get the exact number here. So we're taking 7.75 divided by 74.50. That's 10%. Well, it seems like it should be more than 10%. But I guess not. It's 10.4%, but that's 10.4% between now and September. It's a nice conservative play. This is the way you want to make your money. You don't need to go crazy to make a lot of money. And not only is it a nice conservative play, but we only laid out in cash. We had $22,350 minus $975 minus $1,350. So we laid out $20,000 in cash, okay? And that was a week ago, I think, right? That was on 4/7. That was exactly a week ago. And already we're up, what's that, 318 minus, I'm just taking these numbers for what they are. We're probably up more than this, plus 90. We're up 243. 1.2%. So in 1 week, with this incredibly conservative trade, we make 1% in a week. All right, what does that annualize to? 50% a year. All right, we're not planning on that, obviously, though, because we already capped it at 10%. But the point is, we're on track. We're well ahead of our schedule, because our schedule, we're only trying to make 50% by September. I'm sorry, we're only trying to make 10% by September, but in 1 week, we're already at 1%. But that's how easy it is. You don't have to shoot for the moon to make good money. And the margin on these things are nothing, by the way. When you do these sort of buy rights, they have very low margin because you own the stock and you sell the put. It works out very well for margins. So you can make this a good portion of a portfolio. And your worst case scenario is you end up owning more of the stock cheaply. It's not a terrible thing. I'm not sure what you mean by 150%, but Ray. But anyway, the bottom line is we're capping our gain, though, because we sold these calls. Although down the road, when we get closer to September, we may roll these calls out to like the next year's 7750 calls or whatever, but it's not a trade we expect to make a lot of money. Oh, and by the way, I'm sorry, the CIBC, they pay, I think it's a 4.5% dividend. Hang on. That's another reason we like these guys. Yeah, they pay, while we're waiting, they're going to pay us a 4.6% dividend too. So they got that coming to you. I love these kind of trades. So, we don't anticipate, don't forget the point when a stock pays a big interest payment, they're not going to make a lot of money internally. So it's hard for their stock value to go up appreciably. But so that's why it's also good. That's a perfect kind of play to sell some calls on. All right, now let's get back up here to what Ray said. I think that was it. All right, yeah. So, and we'll get to the short-term portfolio next. So Ray said back in 2009, oil went to 150 after the crash, but USO only moved 35 cents. It makes sense to hold on to USO for a long time. No, it does not. Look, USO has been fixed. I don't want to say really fixed, but it's kind of fixed. It used to be a monthly rollover, and it used to chew up most of its gains would be chewed up by the cost of trading and rolling the options inside the futures. They changed it to a rolling schedule, so you don't get killed as badly from holding USO. But all these, any ETF. You're getting killed by trading fees. They're constantly in and out of positions and trading positions and so on and so forth. The only person who gets rich when you buy an ETF is a broker. Some of them track really well and have a low expense ratio, but you always, over long periods of time, the expense ratio chews you up. You're giving away at least 1% a year, at least. You're giving at least 1% a year away to the brokers who you're giving the ETF to. I mean, why do you think they run them? Why do you think they advertise them on TV? I love people who, they see this because, you see the spiders advertised on TV and things like that, like SPY and whatever and DI. You see a lot of ETFs advertised. And you say, well, doesn't it ever occur to you, why are they advertising an ETF on TV? It's because they make a fortune off you. When you buy these ETFs, they are making money. Your cash is their money. And they're taking a percentage of everything you have. So, yeah, of course, I want to come up with a widely used ETF where hundreds of billions of dollars are put into it, so I collect 1% of hundreds of billions of dollars. That's $1 billion a year. That's a hell of a good little business when all they have to do is just take your money and invest it in this S&P. So that's all they're doing. There's no skill to what this thing does. It can all be programmed into a computer. In fact, that's their quotes feature, is that the computer is programmed to do this and no humans bother it, and they're not making any trading decisions whatsoever. They're just following the index. That's their feature, that they're not going to do anything or touch it. You know what that means? That means they don't have to hire a trader other than setting up the initial programs. It's just a couple of guys collecting your money. That's all it is. That's the joy of an ETF. All right, so where were we? So that's CIBC, and now we'll get to the thing back in 2009. I answered that one. Now, Jim says it's a great feeling to buy back short straddles at a huge profit and then sell out again at the end of the year. Yeah, that is the best. I love, this is my favorite strategy. This is what our long-term portfolio is made out of generally. And this is my favorite strategy. You sit there and it makes money, and next year it makes more money, and next year it makes more money. And I don't know. I don't know what to say other than that. I mean, these are the long-term portfolio from November of 2013. So this is the 15th month. It's up 46.7%, and it's very simple, guys. When we want to buy a stock, we sell some puts. See these short puts? I want to buy ABX for $15. I want to buy Hovnanian for $5. I want to buy Intel for $28. Oh, we just did that one like today or yesterday. I want to buy Intel for $28. I want that's today, and I want to buy USO for $15. Therefore, I'm willing to collect $9,200, $12,000, $1,400. $5,200. I'm collecting this money, which is what? $27,000, $28,000. So I've collected $28,000. This is why we have more cash than we do portfolio value. Yeah, we have more cash than we do value. because I've collected cash in exchange for my promise to buy these positions. Well, let's see. Rig is at 17. Of course I want to buy it for 13. All right? Rig is at, what, we do this twice. No, that's not it. Sorry, that's the wrong one. ABX. Okay, ABX is at 12.52. I promised to buy it for 15. But not 15 because I got paid 460, so my net's like 11. No, my net's 1040 on that one. Hovnavian, I sold it for $1.50. That means my net's 350. Hovnavian's at 363. Intel, I sold the 28s for 280, so that's God knows what. That's like 25.20. And Intel's at 31 bucks. Of course I want to buy it for net 25.20. These aren't hard decisions. It's just a question of us finding stocks we like and seeing that they're beaten up and getting a good price for the puts and selling them. Then what's step two? Step two, some of these stocks get assigned to us, and then we end up owning them. If we own them, though, we end up going to a buy right, like this one. Now, in this case, we started with the buy right because we wanted the dividend. These guys don't pay dividends. But our fallback plan on these guys is to end up in this trade. You know, if we end up having to own the stock, then we're going to sell some more calls and sell some more puts. These custom spreads are what we call generally artificial buy rights. So instead of owning the stock because they don't pay a dividend or for other reasons if we don't want to do it, not no dividend, but not enough of a dividend for us to care. So instead of us owning the stock, we artificially own the stock by buying a bull call spread. That's our artificial purchase of the stock as a bull call spread. And then we sell the puts. It's essentially the same process. Except if we get assigned on the puts, we only own 1x of the stock instead of 2x because we didn't own the stock in the first place. We only artificially owned it. All right? So that's how we set these things up. We are now back in the kind of position that we were in with this long-term portfolio. Last May, I think we cashed out the long-term portfolio. We went to like mainly cash. So, you know, about a year ago, we went to mainly cash and long-term portfolio because at the time we were up around 20%, I think. We completely cashed out our income portfolio and gave up on it. We actually quit the income because it was too redundant. It was almost the same as a long-term portfolio, so it wasn't worth keeping it around. But that was up 20%. The long-term portfolio was up 20%, and we cashed out a lot of positions, and we started from scratch. And that's where we are now. We're starting from scratch. But that's how this portfolio is designed to work. It's designed to make about 20% a year. So if everything goes well, we make about 20%. But more importantly, it's designed not to lose too much money. Because if you can pretty consistently make 15, 20% in a good year, make 10% in a so-so year, because the way these trades are set up, they make 10% even in bad years. In a flat year, they'll make 10%. And if you only lose 10% or less in a bad year, then your long-term average is going to be better than 10%. If your long-term average is better than 10%, you compound that over time, it's incredible money. And that's all we're trying to do. And already you can see how in the second year we are accelerating drastically. Our returns are a huge improvement over last year already. All right, now what we're doing is following a very simple plan, which I wish everybody would practice instead of screwing around with these short-term trades all the time. It's just, you know, honestly, it's more distracting than anything else. I'd rather spend my time looking for long-term trades. I spend, you know, all the time I'm not talking to you guys, I'm sitting on the couch or I'm hanging back here and I'm reading articles and I'm just going through my iPad and I'm looking at articles and I'm looking for trends and I'm looking for things that are beaten up and I'm looking for bargains. Because my passion is finding values to invest in. My passion is not short-term trading. Short-term trading is what I do when I'm bored. Okay, because long-term trading, nobody made $1 billion short-term trading, okay? But a lot of people made $1 billion long-term trading. So I like long-term trading. All right, anyway, and like Jim says, it is a great feeling to just sit there and buy back your straddles and resell some more straddles and then go back to sleep for another year. Nothing like it. Just, oh, how much did I make this time? Great, let's go. Now, the butterfly portfolio does have a hyperspeed. That does it almost monthly. And I'll show you that one next also. We'll talk about that. All right. 1.7 million is 10,000 in fees. Now your broker does 50 or 100 trades a year, way cheaper. Yeah. Yeah, so Mike's absolutely right. It's insane how much fees you pay to these ETFs. They're complete. They publish their fees. They're not hidden from you. But then the worst thing is not only that though, but people buy these ETFs and then they go in and out of them and churn them. And you start moving in and out of ETFs, and now you're adding up. You got a 1% here and a 1% there and a 1% there, and now you're charging yourself 10% fees. That's crazy. You know, the design of an ETF is not to be messed around with. Genworth. Genworth is tricky because I agree with you on Genworth when the rates go up, but they've got some messed up obligations. Genworth's biggest problem is that, let's see if we can pull them up on a chart here. I used to be bullish on Genworth. We used to like Genworth when they were totally beaten down in the old days, but they came back. And now, well, actually now they're down again, but not like they were. They were down to like 2 or something stupid like that. Let me see. I forget where it was. There was some point where, like in 2009, Genworth got so cheap that we just liked it. But in general, they're not the best bet. Silver. Yeah, it was $2. That's what I thought. All right. So when Genworth was way the hell down here, like at $2 or $1, whatever the hell they were, we loved them, and we wrote them up, and they came back, but then we lost interest, and then they went down. We weren't really that interested in them again when they went down. Genworth's big problem is that they wrote this incredibly low. They pushed really hard and wrote a lot of these policies to their wealthy client base. Genworth spun out of American Express, so they were targeting wealthy people. And what they would sell you is an insurance policy that said if you're ever institutionalized, if you're old and you get sick and you get on dialysis, you have to go to a nursing home, and they'll start picking up your coverage. Once you're in a nursing home for more than 6 months or something like that, they begin paying for it, and they pay for it forever. So, you know, you look at it, you do the math, and you look at the insurance. The insurance was something like maybe $6,000 a year for a couple or something like that. And me and my wife looked at it at some point. And, you know, we looked at it when we were about 40 years old. We were saying, well, you know, geez, I think by the time, like, if I give them $6,000 a year, that's, you know, $60,000, $120,000, $200,000 bucks. And I'm saying, okay, so between now and when we actually go into a home, we're paying about $250,000 bucks. How long will you be in a home for? And you know, you can see why it's attractive to them to sell it, because they're going to take the money and invest it and so on and so forth. And you can see why it's attractive for someone to buy it, especially when $5,000 a month doesn't mean anything. So you say, well, you know what, it's kind of nice to know you'll be taken care of. But the problem Genworth's having, though, is since I was 40 years old, which is only 12 years ago, 13, how old am I now? 13 years ago. No, 12, sorry, I'm 52. 52 and senile already. So 12 years ago, when we were looking at this policy, in those 12 years, the life expectancy has gone up 2 years. And that's killing Genworth, because the problem is, as this life expectancy goes up, you're going to have people who are living in these homes for 20 years, and they can't afford that. There's no way they're going to be able to cover that. So, and especially, and again, and the worst thing for them is this low interest rate environment means they have no safe ways to invest this money and get a good enough return to cover their aging people. So that's even worse when you look at it that way, because the last 5 years, they've only gotten a very, very tiny 5%, 4%, 3% a year return on this invested money. But meanwhile, their clients who gave them the money are still getting older. That doesn't stop. Just because they're not making money on the money that they took in, their clients are still getting closer to that date when they're going to want to collect on those policies. So from an actuarial standpoint, Genworth has some serious problems. And what they have to do and what they are doing is they're covering their problem area by getting more and more other kinds of policies. Now, of course, that can go wrong too, especially when you go outside your expertise. But they basically made a mistake. They made a mistake in the underwriting, and they took on something where the facts changed. It wasn't, you know, I mean, look, it made perfect sense when they did the investment, because money in the bank made you 10%. and they knew they could make 10% a year, and you're giving them this much money, and they're going to invest it, and they expected nursing home costs to go up X amount, and so on and so forth. They didn't count on life expectancy, and they didn't count on the rates going down, not paying them. All right, so that's what's wrong with Genworth at this level. I do like them, but I would like them if they crashed. You know, if they crashed again, and it wasn't like they were being called in. But look at this pattern here. I mean, you know, huge things. Like people got out of it, then it went flat for a while, and then somebody else sped up and throws their hands up on the table. Now it's flatlining. Probably the next move is more likely to be down again, because somebody huge or some group of people are exiting these positions. They've lost faith in the company. All right, so that's their story. Is there an option trade to short USO or oil in general going into next week? Sure, of course there is. All right, let's talk about that. But let's see where we are in the short-term portfolio first. Where'd it go? There it is. So now see our short-term portfolios. This is like the bonus prize of the short-term portfolio. Don't forget the short-term portfolio, the paired portfolio. The short-term portfolio is generally about one-fifth of the size of the long-term portfolio. So that's how we allocate our investment. The major function of the short-term portfolio is to hedge the long-term portfolio. But we also make our short-term plays. The plays I say I don't like, I mean, I let you know, it's still fun. So these short-term trading plays, we get in and out of things. We do earnings trades, so on and so forth. But it's more about timing. And we just did so well last year that now this portfolio is up 101%. It's not even supposed to be up. It's supposed to be flat or down, protecting the long-term portfolio. But the way things ran, we just timed things very, very well and made a huge amount of money. You certainly should not expect to make 100% a year trading the way we trade the short-term portfolio, but it's been good to us so far. Now, that being said, look at these hedges. Here's our TZAs. All right, so these are shorts, ultra shorts on the Russell, and we're down $15,000 on those. Okay, so those are the hedges. We're down on these FXIs. We're down on the EWJs. You know, a lot of stuff we're down on. But what we did that was smart is we went long on USO. We took this FAS play. We went short on the financials, and some other plays that are already off the table that we've made some tremendous money on. We do not have a lot of oil plays here. Most of our oil plays are in the long-term portfolio. But here's the way we played USO. Here we played a bull call spread. This was a very good deal. It was we bought these $15 calls for $3. This was back on March 12th, so a month ago. We bought the $15 calls for $3. We sold the $18 calls for 85 cents. So the spread was $2.15. On the $3 spread. That's what we did. That's odd. Oh, it's April. That's why. I'm sorry. These are the April USOs. So these guys, we sold the April one. So we have another month to sell more calls. All right, even though these are in the money. So generally, we'll probably roll these up to the 19th or something like that. But that's how we're making our money over here. And these, as you see, these get jumped to $3.95, and these only are $1.03. So these gained a lot faster than these did. That puts us in very good shape over here. Our hedges are getting killed. I mean, here's SQQQ. Here's TZA again. Here's XRT. That's not even working, even though we had a good number on retail today. It knocked them down. But we have September 100 puts. We sold the April 96 puts, so we didn't want XRT to fall too far. And these are losing money at the moment. All right, so now we can talk about it. So now we've reviewed what we do have. SCO fill. Like or don't like long 67, short April 24. I probably don't like it, but I'll take a look. So if we want to go short on oil, all right, obviously there's USO. That's a pretty direct ETF for oil. It's up 42 cents today, with USO up, I was pulling off a little bit, but up 3%. So a 3% move in oil only has it up 40 cents. It's not a very big move. So that's 40 cents. So what we would take here is you're expecting a pullback in the near future, and so April is too soon because April is only 3 days from expiration on Friday. So you have to go to May. And now we got to look at what kind of positions we can get for May. And it only costs 50 cents. Now, see, I already can tell you, I like this. USO is at 18. It's a 40-cent up move in 1 day, and we think that'll reverse. So if you pick up these $18 puts in May for 50 cents, they have a 32 delta. Okay, so that means for every dollar that USO drops, these things will move up 32 cents. All right, now 32 cents off of 50 cents, though, it's a 60% move. So every dollar this thing drops, you get 60%. So what does that mean? That means this 40-cent move today would have made you 20%. So if this move reverses, you'll pick up 20% off of this thing. You'll pick up a dime. And that makes sense, obviously, because 32 cents is about a third, a little bit more than a third. So that's a good position. Now, another nice thing that people don't understand about puts is it works in your favor because as USO goes down, the delta goes up. So the delta goes in your favor. So your gains accelerate as it goes down from 32 to 40. See that? But if it goes against you, your gains decelerate, so you lose less. All right, so that's a nice thing. So that's a really good position to be in, where you have a very nice delta here. So you get an 8-cent spread on your delta. So you're gonna pick up 25% more money as it accelerates. You know, more of a 25% better delta as it accelerates. That's just an ideal position. That's exactly where you want to be. So I really like those May 18 puts if you want to play oil shorts in the simplest possible way. Now, the other one, though, is SCO. SCO is an ultra short. Now, Scott said shorting the April 72 calls. That's a weird one. Like, how much could they possibly be? What? Wow, that's crazy. Okay. Even though UCO dropped $3 a day, so it started the day at 70 basically. So even though UCO drops at $3 today, that's still a crazy price because these things expire on Friday. So you're looking at, if you split the difference between $1.30 and $1.55, you're talking about like 80 cents, 90 cents, let's say, for these calls. So yes, I do like them for a short call. That's a very good idea. That's a very good idea, Scott. That's perfect. If you can sell those for 80 or 90 cents, absolutely yes, especially since you're going to be covered with the May 67 calls. Now, I think May 67 is a little deeper than you need to be. I would really just cover with the, let's see. I would try to find one with a good price. That's the trick. Maybe the 70. See, 475. If you can get these for 475, which is the low end of this range, I would want to go for something like that. And you probably can, because see how this has the same range. A strike lower has the same range. And this range is tight at 580. So even here you can see that you can get these for the 68s you can get for like 560. So there's no reason you shouldn't be able to get these guys for 475, which is what it says over there. So if you can do the 70s for 475, I wouldn't see the point in spending an extra on the 67s, an extra buck. I don't think I'd spend that extra buck on the 67. Not an extra buck. It's going to be 540 plus maybe 6. So you're spending an extra $1.50 for the 67s. I think it's more commitment than you need to make, especially because you're making the smaller commitment here at 475. If you sell those other things for 80 cents, you're down to $4 on that already. Okay. Although, and again, I would rather in this case take a spread. So then I wouldn't mind taking like the 67s for 560, and then I'd sell whatever I could for 360, which would probably be these 76s. So now now you're spending $2 for the spread, for the 67, 76 spread. So you have a $9 spread for $2, and you sell those May calls. I'm sorry, you sell the April calls for $1. Not $1, but 80 cents. And now you've knocked your net on your spread to like $1.50, and you're in the money. So I prefer, or you're on the money anyway. So I prefer something like that. But that means then the April call is a naked call, so it depends on your margin requirements if you can do that or not. Mike says, do we still like CHK down here? No, I don't like CHK. We've talked about that before. I don't know what CHK is anymore. They've sold off so many assets, and they don't have Aubrey anymore. He left, the old CEO. He was the one that was a genius at running the company. It's a very, tricky business. It's, being a wildcatter of oil and gas is a tricky business. I don't think they're a bad business, but I think they sold off so much stuff, and so many of their assets have been spun off and put into different things here and there that I don't really know what the makeup of the company is anymore, so I can't really bet on them with a good heart because I'm not sure where they're at. It's been beaten up because the new management isn't as good as the old management. And I got to tell you, I mean, the criticisms of Aubrey back in the day were that he was a wheeler dealer and he was wild about his stuff and he took great chances. You know what? But those great chances paid off, and he was fantastic at making these deals. And that's the problem with the new management, though. They're not as good at making those deals. Aubrey could sell, he could sell, ice to Eskimos or whatever you say. So if he had some bad wells, he would sell them for top dollar to some sucker because he knew everybody in the business and he knew people who would pay him for whatever he wanted to offload and get good prices. And he was great with the timing, great with everything else. That's the nature of that business. That's how he ran it. So, you turned it over to bean counters, and they're just not as good at it. He was a unique person, and he's the kind of guy you want. It's like Las Vegas Sands. When Shelley goes from Las Vegas Sands, don't play Las Vegas Sands. They're going to be a terrible company because that company is completely based on his wheeling and dealing and his very aggressive nature and the way he makes all these backdoor deals with governance and things like that. You can't expect the next guy to do that. These are not up-and-up companies. These are companies that are based on a lot of them, the personalities of the guys who are doing it. That goes for Tesla, too. When Elon Musk goes to Mars, you're going to have a lot of problem with Tesla because the only reason Tesla's stock stays up is because he's an incredibly good bullshitter. So you can't just, it's like you can't expect the new CEO to be as good at it as he is. So anyway, so no to CHK because of that. It's just I don't see it as a company, as a viable, robust company. I don't want to say viable. I mean, I don't see them as being a robust entity anymore, and that's why they're being fairly priced to the market. In fact, let's take a quick look. We like to do our little valuation lessons. And if we go to, if I could find it, we go to CHK. Oh, that was smart. I typed correctly, CHK. And we look at their income. All right, so they have good income growth. They're making nice money, but a lot of that money, I think you'll find if you examine it, is in, see here they have this non-recurring, very large non-recurring, well, I'm sorry, that's an expense, I imagine. But you'll see in their balance sheet or somewhere, you're going to see they're selling a lot of assets. See, look at the amount of cash they've raised. They went from $900 million to $4 billion, and that's because see these long. Wait. Oh, here you go. See the property, plant, and equipment. They sold off almost $5 billion there of property, plant, and equipment. All right, and that's what I mean when I say I don't know what the mix is anymore. It looks exciting. But I don't know what's left, and I don't know how profitable. What if they sold off their best $5 billion? It's hard to say whether or not what they have left is going to produce at the same level, and we don't really have a long enough period to look at it to figure out what they're doing. What you can see, though, and they've been buying back a ton of their stock. They pay out their dividends, which is fine, but they buy back a ton of their stock. They're still doing CapEx, so you don't know what's going to pay off for sure. And on a quarterly basis, we can see that. Good. Okay. So on a quarterly basis, this is a one-time thing here that's bumping up their numbers in December. But basically, they're running 374. These are down 144, 169. That's not like there wasn't anything of natural gas or prices or anything else that did them well this year. It's that they had a what is it that bumped them up so much? See, isn't the revenue? Oh, this. Look at. See, this is weird, huh? For whatever reason, they had this. I knew they did something weird in December. The cost of revenue, it doesn't make any sense. Look at what happened. You know, they moved some of it into here, so let's say it's 3.7. But even so, it's like, what happened, and why did they restructure? It's all in their restructuring how they're selling things off. I don't like it. That's the bottom line. It just happened recently, and I don't know what they did, and I don't understand it. And if I don't understand it, why would I play it? You know, it's accounting stuff. They've gone, you know, they've gone from wheeling and dealing to accounting tricks, which is not my favorite way to go. All right, what else have we been talking about? We got the portfolios. Oh yeah, I was going to talk about the butterfly portfolio. So, if you're not patient enough to wait for the long-term portfolio plays to come in, we have a butterfly portfolio, which is doing a similar thing to what we do in long-term portfolio. It actually has similar performance, though. It's not like there's a huge performance advantage. But it does it at a faster speed. But it's also, I like it though, it's good for practice because it lets you practice your option selling and your long-term trading, and a bunch of strategies come into play in a long-term portfolio. And, one thing I noticed though, people with a butterfly portfolio, it's not a good idea to follow one of these trades. You know, when you're doing butterflies, you really need to have a few of them because some win and some lose. And you don't know which ones are going to win or lose. The idea is to have a diverse amount of them because we're selling a lot of premium. And statistically, if you constantly, this goes back to being the house in the casino. If you only play one game, even if you have a statistical advantage in that game, you could still have a bad run of luck in that game. Like JP Morgan just went popping up on us. Others of these, I'm not sure which one in particular, but others of these have gone the wrong way for us. I think OIH, I think, has done it. It shot up too fast and went off our track. You can have a bad run of luck in an individual game. The thing a casino does, as you know, is a successful casino has 3,000 tables. You know, or like things like the 3,000 slot machines, tables, so on and so forth. And they're playing thousands of games. And the reason for that is because the more games you play, the more the statistics are going to line up in your favor. The more the statistics will true up. In other words, the more times you play these games, all the various statistics, they'll all be off. One will be up, one will be down, one will be neutral. But the bottom line is, over time, you have a much better chance by diversifying all the games you're playing. That's what casinos do, and that's what you have to do in this kind of strategy. Because this strategy is very, very dependent on statistics. All we're doing is selling a lot of premium. We take safety positions, long-term safety positions that cover us in case the stock blows out too high or too low. But generally, we could care less which way they go, and we're just selling as much front-month premium as we can on these positions. That's the gist of this portfolio. It's not a complicated strategy. People think it's complicated, but that's all we're doing. Is we just keep selling front-month premium and making as much money as we can off of that. Since these statistics are incredibly in our favor selling front-month premium, we collect a lot of cash. And this portfolio, too, is very, very, this is, again, similar to the long-term portfolio. We have more cash on hand, $148,000, than the value of our portfolio. And that's all we do is we just keep selling positions. So we're not committing a lot of capital to this thing because we sell so much premium. We try to sell more premium, in fact, than we actually own on the long-term positions. And the more we do it, the better it is. And the tiny little advantage that we have, 2%, 3% a month advantage, just add that up every month. And if you can be consistent at it, you're going to make 20, 30% a year. So this is a fantastic strategy. It's a great thing to follow, and especially if you want to learn about adjusting options and moving options and changing positions and picking these new positions, this is a good portfolio because it's probably the one we discuss the most. We spend more time discussing these positions. I get annoyed sometimes, in fact. We spend more time discussing these positions than all of our other positions and all the other portfolios combined, even though there's only like 13 actual positions here, because they are technically more complicated. They all have 4 legs, at least. Some of them have 6 legs. But all they are at the core is we're buying a long-term position to hedge our short-term positions. We sell as much premium as we feel comfortable with in the short-term positions, and that's that. And we do it month after month after month, and it's a consistency that makes the money. That was the whole point of setting up this portfolio, is I wanted to make sure people understood it doesn't matter if you win or lose. There's no individual trades. It doesn't matter. We're basically selling the market. And here we have a chip company. We have Valero, the refiner. BTU is a coal company. We have Disney in the entertainment. We have JP Morgan's a bank. OIH is also in the oil patch. Here's UNG. We play natural gas to do well, and Walmart is retail. So we are diversified. We are playing a diversified mix of things, and we're playing them just the same way each one. We sell puts, we sell calls. We don't give a crap what actually happens month to month. Some months we win, some months we lose, but the bottom line is we always make our premium, because that's a fact. Premium will decay, and we sell it to people. So cannot make that point enough. Now, poor $25,000 portfolio has been neglected a bit. It's up 32%. It's very hard to make money in a $25,000 portfolio because we have no margin. And we also have day trading requirements, so there's a couple of ways this burns us. But we took a shot at Lumber Liquidators here, which is not paying off so far. And we've got our USO play, which is looking good. That's completely in the money. No, not completely. We're nickel out. But our target for USO, in 3 days, our target for USO that we took on 211 was $19. And where's USO? $18.95. So I think that's pretty good, considering I made that call in February. And this is our least flexible portfolio. So back in February, I said, look, here, we're going to bet $1. We bet net $1, and we bet 10 of them, so we had 10,000. We have 10,000. We had a $1,000 bet on February 11th that USO would close at 19. In a $25,000 portfolio, we weren't able to play games. They were, basically this was a win or lose bet, and we're winning it. All right, so whether it holds up for the next 3 days or not, that's going to be tricky. And probably, damn. Now, you see, if I were able to, I would cash out this 191 and take the money, but I can't. Well, let's take a look. Let's see 17, 19. Maybe these are bad spreads. So let's take a look where we really are on this thing. Never take your broker's word for how much money you have. The 17s are 195. The 19s are, no, here they are. Nope, it's correct. Those 19s are 30 cents. So we only can take $1.70 if we take it now. So now we have to weigh the risk of saying, are we going to be satisfied with a 70-cent profit when we're really 5 cents away from a $1 profit? But the problem is, if oil retraces drastically, we are not going to have that. We could lose more than 30 cents. So we have to think about how much we think we're going to lose for 30 cents. That's the trick to this particular trade now. So it is where we want it to be, but it's exactly where we want it to be. And I would say I would ask for 80 cents. I would try to get 80 cents out of this trade. Net 80. So maybe if you can sell this for 195 and get out of this one for 15 cents, it's not very likely today. I would take that trade, because that would be close enough. I think you'd be happy for the risk, but risking, I don't think I want to spend an extra 30 cents to get out of it today, even though I may live to regret that. So I'm going to have to I'll give it more thought later, because I don't like to lose money when it's sitting on the table right there in front of us. This is not bad. This is good 600 plus profit right there. All right, so off of that, and now let's get back to where we were as far as talking about stuff. Oh, yeah, some news items. Some interesting stuff that was going on before. So whenever people stop asking me questions, I like to read the news, and then if I read something interesting, I pass it along. So when you see these small news items, it's just stuff that I'm reading that I think is worth putting forward. Now, so some interesting stuff. China's slowing, we know about. Zillow had a short 2015 forecast. They're blaming it on their acquisition of Trulia. I don't know about that, though. I think that's kind of bad for housing, though. So in my mind, that's sort of like putting a negative check next to the housing market. Pass the menu, hold the shopping cart. I have no idea what that meant. Some of them don't have very good explanations. Google is having trouble with the EU, and that's coming to a head now, where the EU may start requiring them to do. I don't even know what they require them to do, frankly. They're just not happy. They're like a search monopoly. The European Union doesn't like that. So that's going to be interesting. This is bad for coal. A planned carbon market fix will be difficult, but it's going to be coming through from the EU. And again, when they start putting caps on carbon, that affects everybody, even though it's just the EU doing it. Greece still in trouble. That's something you might not know. Canadian stocks are down, even though it's weird though, because they fell today, but then oil shot up, so who knows what they're doing right at this moment. But then the rails went down because we had bad news from the rail yesterday. That's been completely, by the way, washed over by this booming oil number. Is that the rail numbers were bad, and we expected the Dow to go down today. The Dow went up instead. At the moment, it's back at 17,950. It touched 18,000 for a minute on the futures, and I love them short there. And we talked about shorting the 17,950 too, though. I like them short here. I like them short here. I like them short anywhere around here because they should be down here. They should be a good 100-something points lower. So I do like the shorts on YM at this level for sure. I like that. That's not a picture men want to see. Christine Lagarde does not like your economy. Here's OPEC, daily production of oil by 5%. Oh yeah, well there's another booster for oil, okay, because OPEC is saying they should cut oil by 5%. It's the same noise they always make, but this is one of those things that boosts oil for a couple of hours. This is cool. They got a thing that automatically pulls honey out of a beehive. You don't have to put on your beekeeper hat and do it. It's a good article, actually. It's funny because it's good because it encourages people to keep bees, but it's bad because amateur beekeepers don't know what they're doing, and they can actually infected hives. If you don't take care of your hive, the bees get sick, and if the bees get sick and then they fly around, they can make other bees sick. So it's got negative aspects to it as well. But it's good that people want to take care of bees at all, so you have to kind of balance it out. The IMF trimmed Canada's growth forecast, which is rightly so, too. There was nobody had really come down on the prices based on oil. Some of the interest rates, when you have when you have mortgages or loans that have you pay prime plus something, and that's your rate. In Europe now, because the rates have gone negative, there are actually banks who have to pay people who have loans, because they took out a loan that's like prime plus 0.5, and now prime is minus minus 0.75. So their rates have gone negative, and they have to pay, or it's probably linked to a bond or something like that. But the bond goes negative by 1% or something like that, and then the bank has to pay the person a half a point for the loan. Yeah, and the German bonds too. Everything is just insane. But this to me is just hysterical. I mean, imagine having a loan, all of a sudden the bank's writing you a check, your interest check for the month. Yeah, the yields are crazy. The money's crazy. But think about that though. I want to get one of these loans. Where do you get these loans from? I want to buy myself $1 billion building at negative 0.5% or negative 1%. And they can pay me every month for owning the building, in addition to the rents I collect and so on and so forth. Give me a 100-year loan for that one. I'll take it. The shale output's going down. So there's a bunch of news here about oil that's positive for oil here. Here's the shale is declining, which is what they wanted all along, which is, and again, this is what we expected. And back in February, when I took the USO position, this is how long we expected it to take before you'd actually see the effect. I mean, it takes time. We explained this back in February. It takes time for these changes to move through the system to actually start affecting output. And everybody expects it to happen right away, and everybody's freaking out about oil, but it just takes a few months, that's all. And then it starts coming in. So we're still on target for a $60 call for July, after the sell-off that we're going to have now, of course, which is coming in the next few days. Let's see. Ease. Who is this? Shoot, somebody like Snoop Dogg or somebody. I think Snoop Dogg is an investor in this thing. He does an on-demand marijuana delivery service. I love that. Japan. This is very big for CCJ. I knew there was one I wanted to talk about today. This one, CCJ. Japan has an injunction against it. You're going to start 2 reactors. The court put down an injunction. All of Japan's reactors are still offline, and that has been killing CCJ. And let's see if I can find that. So, of course, they're taking it badly. They're down 1.5% today. I do like them, but we had them in long-term portfolio, and they're one of the ones we gave up, though, even though they're a materials play, because it's just taking forever. They're not restarting these goddamn reactors. It's a nasty thing. I just think it has to be done, though, especially when the EU starts putting in these coal restrictions. People have got to get nuclear online. And it's going to be very, very strange. So I do like CCJ here. If they hold 15 on this test, I'm going to like them a little bit more. They really aren't going to go down much further than this. This is a fantastic entry point. It was just that when we shut down, when we cashed in the portfolio, they were up around here, and I was like, oh, this is good enough. I'm like, 15 was good because we just come off at 13. And I was just like, you know what, that's a nice game, and let's just put it in the bank and forget about it. I do like them, though, and I really think they are too low. I think that what's going to happen is probably this Japan thing will work its way through the courts, and sometime in the summer you're going to see, because they're going to need the energy. They need the cooling. They have hot summers. Right around this time here, which is coming into like July-ish or June, you're going to see them allow restarts of the plants. And that just brings up a huge customer back online for CCJ. So it's definitely playable, but not right this minute, but I do want to watch them. Let's see. Do we like GLNG? Have not considered them. I'm not a big fan of LNG plays, so it's hard to say, but I generally don't like them, because I think the liquid natural gas guys are probably, I think it's going to consolidate, and like half of them are going to fold in the end. They're up on a lot of speculation that's nothing actually happening. These guys, they really don't, they really don't have the kind of money that justifies their valuation. The valuation is like $3 billion or something like that. Is that right? Yeah, their valuation is $3 billion, and they make, this is annual, they make $100 million. That's not good. Okay, you don't really want to see that. Okay, I don't frankly, and the billion that they made here was from other income. It wasn't from their operations. So you also have to realize that, when you look at these reports for companies, you have to understand how they're making their money. They made their money by horse trading plants and so on and so forth. They didn't make their money by actually running an LNG operation. Nobody is making money running an LNG operation, not to any great extent. So it's very, very speculative. 3.5 billion. Their normalized earnings would maybe be a couple of $100 million. So at 3.5 billion, you're talking about it's not, try to get the number right. 200 million. So it's 15, 20 times. It's not terrible, but it's not where you want to be for somebody who's sort of drifting along. So, would I play them here, at where they are now? And let's take a look at them on the other chart. I just think it is a commodity play in the end. The valuation should be very low. So this was irrational exuberance. Like I said, the numbers you saw there weren't real. It was a one-time deal they made. That money came in, it's gone. They don't even have that plant anymore, and whatever they sold, and now they're back to here, which is normal earnings for them. This is where they should be. So it's not the same company that made this money. So you can't expect it to go back to that level. They don't have those facilities anymore. And over the long run, they should have a low valuation, a low PE, because they're just a commodity play. They're moving natural gas. I don't think that's going to help anybody at all. The only thing about liquid natural gas that is a big deal is that because to initiate the process of having LNG, they're going to compress all this gas and pull. So the gas producers are going to make a lot of money because they're going to be supplying all the LNG people with stuff that they're sticking into the ground. But then the LNG traders, they're just sitting there with this commodity that they're going to have tons of, and there'll never be a shortage again because of it. Because of the LNG facilities, there won't be natural gas shortages anymore. And then how are you going to make money off of that? So it's not my cup of tea. Let's put it that way. Whole Foods pulling back. Yeah, we love Whole Foods when they get cheap. Boy, those guys are good. They know their market. Now, I really like the Europe expansion. We talked about this last year. They already paid off for us. We're out of Whole Foods. That's another one we just sold recently. And if they do pull back, I would totally love them down here. Sure. All right, 2:30 already. Going to have to go. Germans. We talked about the Germans. And yeah, that's a good point from Mike. He's saying the LNG tanker plays is cyclical. It's just a whole LNG thing. It's this fantasy that people have, and the people who are pushing LNG are these CHKs of the world who are the producers. Because obviously, if you build this LNG facility, and the step one is you have to fill up your storage tanks. That's how you have a business in the first place. And the guys who produce natural gas now are like, oh, that's fantastic. How much gas would you like? They'd love to see you take the gas and stick it in a hole in the ground or put it on tankers and send it somewhere else. Anything to create more demand for gas, they're 100% in favor of. So, if you want to play LNG as a thing, the best way to play it is just go long on natural gas, which, like I said, we are. That is one play we do have in our portfolio still. The RDSBG, DBA, we talked about, that's a good one for you guys. If you weren't in our chat today, since I got some free people in here, yeah, we did do a DBA in chat today, so let's take a look at that. RDSBG would be the biggest LNG play and will pay a 6% dividend. That's true. That's a good way to play it. If you want to believe in the LNG, it's a good way to play it. But again, I think Shell is also, they've got incredible amounts of gas worldwide, and they just want to make sure a big LNG play pays off. UNG pops on the weather, but what's going to happen is once they have all this LNG, once they liquefy the natural gas and store it, the weather won't be a factor anymore. That'll be bad for natural gas, actually. The weather is their whole thing. It's all the speculation that there's going to be a shortage somewhere because of hurricanes. And by the way, this year is a good year for those kind of plays because you have El Nino causes more hurricanes, and hurricanes are what knocks off the natural gas production. So it is a good year to be in UNG. And hang on, let me see what we look like there. If you want to play gas, just play gas. Oh, it's pretty cheap. Okay. So I wouldn't mind that. I think UNG is down at the lower parts. Natural gas is, here it is, 250. We like natural gas down around 250. That's generally the low point for them. Let's see if we can pull up a natural gas chart. But it's pretty low in their cycle, but of course it's the end of, it's the end of winter. This is what you expect. You see how nice and low they are here. So yeah, we're definitely interested because normal for them, $3 to $3.50 is their realistic range, and they'll go higher sometimes and lower sometimes and whatever. But $3 to $3.50 is about the right price for gas. But these LNG projects are going to create demand. I just don't like right now making a stand on it because it could go back down to 2. So it's not something I would enter right this minute. But I do kind of like UNG long term, especially I'm going to like it into about July, because that's when the hurricane season starts, about August to November. And all you have to do is be lucky and hit a hurricane. It's going to pop up like $1 or $2. And that's huge money on UNG. Okay, so back to DBA. That was our play today. In chat, we talked about this. Here we go, and we'll find it. DBA. So this started with Scott saying, with the drought in California, it looks like food prices might actually go up sometime. And Spain has no summer so far. It's cold over there or whatever. So what we were looking at here, here's DBA. Now DBA, let's get back to here. DBA is holdings. Here we go. Here's what DBA is. It's sugar, it's cattle, it's corn, it's soybeans, it's cocoa, it's coffee, it's hogs, it's wheat, it's soybeans again, and it's cattle again. So it's a lot of cattle and soybeans and whatever. But this is what it is. It's sugar, cattle, corn, soy, cocoa, coffee, hogs. That's so just keep that in mind when you think about like what it's going to affect. It's not all the different crops. It's not avocados or crap like that. Nobody cares how many avocados are grown. Somewhere in these holdings, probably if you go deeper down, there are some of those things. But really, DBA is trading the big guys, the things we use tons and tons and tons of. The sugar and cocoa and the coffee, they're very regionally specific. Cattle, of course, is everywhere, and then cattle gets back to corn. The cattle eat the corn. If there's more cattle, there's less corn. If there's less corn, then it's expensive for the cattle, and they cut back on the cattle. It's a huge dynamic to the whole thing. But the bottom line is, of course, obviously, if there's bad crops, there's bad crops, and that's going to drive up prices. So you don't usually figure DBA is going to go too low. And also, though, the thing about DBA, though, is it's an inflation hedge because the price is going to adjust to the dollar. So down around here at 22, it's really super duper attractive, okay? This is very, very low. And at some point, here's what happens to it. When there is a problem, it'll go down and down and down, and it'll bottom out for a while, like it's bottoming out now. This could last for ages, it can last for a year. But at some point, something happens that drives up the prices. That's just normal weather cyclical stuff that happens with crops and things. So food prices go down because everything's good and we have a bounty, and then something happens, and then there's a need for more. And it rises dramatically with very little warning. It's pretty typical for these guys. So, and in fact, we can look at a longer term chart. There's my Yahoo. Okay. You should see this pattern. See how this pattern repeats? Way up, back down, drift, way up, back down, drift, up, down. So, this is early because it's probably going to be here and drift for a while. Then it'll spike. If you can't take advantage of that spike, though, what's the point of being in the play? All right, so keep that in mind also, that when it does spike, you have to recognize it's spiking up and not start having this fantasy that it goes back to 27 and you're going to be like, oh, it's going to be 50, I'm going to be rich. No, 27 will be it. That's a nice spike if it hits 27. So if you want to play that, oh, sorry, that's the wrong thing. Here it is. So we took a very simple play, selling the January 22 puts for $1 and buying the 21.23. Notice I'm being super conservative here. I don't care if it's 27. I'm just saying that I think I don't care if it goes 27 or not. I say it's going to be up around 23. I say this is a bit too low, and by January we should settle in around 23. which is very much like my prediction on USO that's working out so well. And, damn it, sorry. And you look at the spread, it's $1 for a $2 spread. You make 100% by January. Between now and January, you make 100% on the dollar if your premise plays out on DBA. Why would you need to take a riskier play when you can do that? And if we get partway through the year and DBA is cheaper than we think, here's the deal. In fact, I sent this one out as a top trade today because it was a good one. If you pick up the, what was it, 21, 23? So if you pick up the 21s, they're $2 or $1.90 now. See, somebody was selling for $1.90. You sell the 23s for 90. That's a $1 spread, exactly what we were looking for. All right. There's no margin to this trade. It's just cash, and that's all you have to do. But if you also pair it, and I think, did we talk about pairing it? I lost track now. No, I didn't even pair it with a put. Why did I say margin then? That's weird. Oh, I did say selling the puts. I'm sorry. Oh, it's net zero. That's why. If you sell the 22 puts, so then you sell the 22 puts, and again, it's all you're doing is putting your foot down on DBA and saying it's going to stay over 22. And if you sell these 22 puts for $1, now your net cost is zero. And what I said about the margin, if you sell these puts for $1, there's wow, that's weird. You collect, this is for 10 of them, but your margin here, your buying power effect is 240. I don't know why I got 40 cents. But your buying power effect is 240 for 1,000. I'm sorry, it's 2,400 for 1,000. So it's $2.40 per contract, not 40 cents. I don't know where I got that. That's really cheap though, because you're going to make $2,000. So you take $2,400 in margin, and your upside on 10 contracts, and your upside is $2,000. That's extremely good. You know, for a not even, I mean, it's not even a year. It's only 9 months, not even 9 months. All right, so you know, instead of messing around with this or that or this and that play, and instead of speculating it's going to go way up here and trying to take a call, it's like, no, be the house, sell the premium. And all you're going to bet is that the thing goes up a little tiny bit between now and then. Now, if it doesn't, you don't forget you net zero on this trade. So all you're going to have to do is when 2017s come out, you take whatever's left on the 21 puts, like $1, and you roll that out to the next year. So you buy yourself another year of time. So, you know, this trade doesn't lose you money until the fat lady sings. You can also roll the puts out to the next year as well. So that's an excellent, excellent trade. So let's go back to just how it looks visually. You know what it was? I think I was looking at a margin account before. This one's not a margin. This is a non-margin. So where was I? Non-portfolio margin, sorry. The 22 puts. Right. So you sell the 22 puts for $1. Use that money to buy the 21-23 spread, also $1. And you have a cost of zero cash and $2.40 in ordinary margin. That's what we were looking at before over here. So your cost is $2.40 of ordinary margin. So if you put aside $2,400 in margin, this spread is for January. These are all January figures. So you put aside $2,400 in margin, and your upside at 23, which is if this thing goes up 75 cents from here back to this line, then you make $2,000 profit. And your risk is owning DBA at 22. That's your risk. And if you do own it at 22, then you turn around and sell some more stuff. When the spread pay off, should I hold on to the January puts after? Well, you can. I mean, if the spread pays off, those January puts will expire, and there'll be nothing left. You know, they'll go to zero also. So no, you know, ideally we would just like to get our $2,000 and be done with this trade in January. If we end up rolling or adjusting it, we'll talk about that in chat when the time comes. You know, it's not a big deal. We didn't officially take this trade. We already have in one of our portfolios. Let me see. Must be the long-term portfolio. I thought we had it. Wait a minute. Maybe we don't have DBA. Am I wrong? If we don't have DBA, we should put that in long-term portfolio. Okay, I will add this to long-term portfolio because silly me, I did not realize that we do not have DBA. Of course I want DBA at these prices. I can't believe I didn't think of that earlier. All right, so that will officially be a play in the LTP. We're going to do 20 of those. Oh, look at that. We made some more money. We made $1,600 while we were talking. So that was a worthwhile seminar for me. Let me see, DBA, right. So we want to add like 20 of those in the long-term portfolio, and 20 of them cost zero. Takes up, see why we have so much cash in long-term portfolio. Takes up none of our cash, but it's going to cost us $4,000 in margin. And that's the way we're going to play it. All right, so that's nothing. I mean, out of all the margin we have sitting around doing nothing, it's nothing. But on the other hand, if we make the money, it's going to be $4,000 in cash. And if it doesn't go well, we're happy to roll it and double it down and do whatever, because long term we have faith in the position. Then this is just an initial entry. But if all goes well, we'll make $4,000. And with the long term portfolio, we're only trying to make $50,000, $70,000 a year. So every month we just have to find one position that pays us $4,000 or $5,000. And that's how we keep it going. That's how we keep our gains moving along. It's very simple. It's a very good strategy. Once you build these portfolios up, they're just so easy to run. They get easier and easier to maintain as time goes by because of plays like this. Because you say, oh yeah, there's a $5,000 trade I can get into. No big deal. All right, so that's all the time we have for today. And we'll be back at this thing again next week, and we'll have a lot of earnings to discuss. It's going to be fun, and we'll deal with that then. All right, thanks everybody for coming. I appreciate it. And we'll do it again next week, all right? Thanks, I'm back to chat now.